And the most bullish thing about Bitcoin probably is the fact that the entire world's institutional investors don't own it. Because they will own it. I promise you, Jordan. In 10, 20, 30 years' time, they'll all own it. Yeah? It's how it works. You know, and then you've got the arseholes writing these stupid comments in the FT. They're going to retire. They're going to be irrelevant. And then the new lot will come in. They'll be in charge. And they'll go, well, why don't we like Bitcoin? What do we like Bitcoin? So it'll be normal to them. So one way or another, it's coming in. Yeah, it's happening. It's just a slow grind. But gold, quite a lot of institutional investors own it. Not all of them. Lots of central banks own it. But Bitcoin, no one owns it. It's the most bullish case, if you just wanted to make one point, is they're all coming.
Charlie, it's good to have you on the show. How are you doing?
Very well, thanks, Jordan. Good to be here.
Yeah, I was trying to rack my brain before we jumped on and think when did we first meet? And I think it was do you remember the restaurant in Wandsworth where we ran an event called Hard Money?
Yeah.
And you came and talked at that, and yeah, it was fantastic. And also thinking back to that time is there was a few people in that room, and I'm not sure if you're aware of this. There's a few people in that room that your talk helped them get over the line, understanding what Bitcoin actually was.
I'm sorry about that.
It is because there was quite a few gold bugs in the room that were just like maybe not quite understanding what the angle that Bitcoin was coming at. And yeah, your talk brilliantly presented how you can view both of them. And there was some quite influential people in that room, and so I'm very grateful that you came and did that event, because that's really helped us as well carry on those conversations.
Yeah, well, it was a really fun evening, and what a very interesting and different but excellent restaurant.
It was, and unfortunately it's no longer there, which is a shame. But anyway, let's get into the show. And could you tell us a little bit about your background, and then how you came to founding ByteTree?
Yeah, my background is I joined the army in my 20s and left and joined the city. Went to HSBC Asset Management, where I spent 17 years. Did quite well there. Grew a multi-asset fund, and left in 2015, and went my own way from then on, really, in a sort of plural career. And the last few years, I've doubled down on ByteTree, and that's now my full-time existence. So ByteTree.com is primarily a research business, and we do mainly, the vast majority of what we do is TradFi, shares, bonds, that kind of thing, commodities. But then we do a little bit of crypto research. It's a small thing that we do, but I think we do it quite well. And but the thing that's we're probably best known for is Bitcoin and gold, because we've got an ETF, ETN, ETP, call it what you will, that we've been running for the last 3.5 years. So that, in a nutshell, is who I am, with a background in asset management, and I've just sort of focused on doing things a bit differently.
Nice, I love that. And it's we'll get on to the bold and joining goals with Bitcoin, but yeah, what made you leave and actually go your own way, start your own thing?
Yeah, well, I think it came to the end of the line, really. I mean, 2015, 7 years after the credit crisis, I was sort of every year I was like a slowly boiled frog, waiting for things to go back to the old days, and they never did. And once the realization finally dawned that the world had changed, and the future of my job was allocating to ETFs and stuff like that, whereas it was time to move on. So we had an extraordinarily successful run into the crisis. We had a fair crisis, not a bad one, as asset managers, and came out the other side, and the world changed around us. And so the sort of things that we were able to invest in pre-08, they were slowly curtailed. And so, having one of the best jobs in the whole world pre-08, I probably had started to feel a bit like a civil servant by 2015, and so, time to go my own way.
How was it going your own way from?
Well,
Had you worked? Sorry, I'm totally digressing here, but going from the army to then working in the city and then building your own thing.
well, you
How was
crash,
that?
don't you? When you go from prep school to big school, you crash. When you come out of school and go to university, you crash. You crash when you come out of university. Then you go to Sandhurst and you become top of Sand. Then you crash as you become a junior officer. And these crash. So every time you change, it's a crash. And I have to say, going from a steady number at HSBC Asset Management to your own business, Plural Life, was a very large crash. I think I have to change again. I really haven't got the energy again to go through it all over again.
It is. Yeah, I know the feeling as well. Do you think, actually, going on the point of things were never the same pre-08, do you think we've kind of seen something similar? I'm not saying the same, but do you think we've seen something similar from 2020, whereas things just wouldn't go back to the same as they were before then? People are potentially moving more towards things like gold and Bitcoin.
Yeah, I mean that's the sort of the pursuit of alternative assets. But let me go back to 2002 or 2001, really. So once there was a broad acknowledgement that the dot-com era was crashing, and it wasn't just dot-com. So everyone refers to it as pets.com going bust and Amazon going down 95%. Well, actually, the biggest stocks of the index, it was Vodafone, stuff like that, and lots of GC Marconi that went bust. These are proper blue chips that were widely held by private investors in the UK. And it was a devastating time. And I think that it took, as with all bear markets, it takes quite a long time for people to accept it and recognize it and even utter the words bear market. And so there was complete denial in 2020. But anyway, as we came out of it from 2003, the leadership of the market was nothing like what it was in the 90s. No one cared about growth stocks. Tech really didn't play very hard. Internet stocks still lost money. Biotech stocks still lost money. And yet Brazil and India and China, these stock markets roared alongside commodities. So you had, gold going up and that sort of thing, and Brazil and oil. And I ran a portfolio service in those days that focused and just said, okay, stuff it. We're not going to buy big American stocks. We're going to buy all this stuff that's going up. And it was extraordinarily successful. And, it was great. And I think it was not that the world changed. I think that if you worked inside a bank, it changed. Our environment at HSBC, and I hold HSBC in high regard. I'm not slating them or anything. It just changed. And I was like an entrepreneur, as you call them, an entrepreneur within a large organization. And I guess there was a couple of thousand people like me at HSBC around the world. And I think they just sort of cut the lot of us down to size and turned the thing back into a single brand corporate machine. And there was, you just couldn't do it. But also the market changed. Suddenly the S&P was back in charge. So the S&P underperformed the world massively between 2000 and 2008. And then in the aftermath, it started outperforming again. It has been outperforming ever since until this year. The dead dull index portfolios have actually been working really well. Now, I don't think they will for the next 10 years, but for obvious reasons, they're very expensive. The securities they're owning are very expensive. So that's unlikely to perform. But, I think we will go back into that world that I enjoyed so much from 2002 to 2008. And I think the index fund is a not all index fund. I think we're generally track, of course, but the big ones like the World and the S&P are just dangerous places to invest, frankly.
I saw that you put a chart out on socials the other day, and it was US equities, comparing it with other countries. And it was the US equities, if you take the Mag 7 out of it, they're actually not performing very, very well at all.
No, they're not. So the 493 stocks of the S&P have been pretty weak as a group this year. and they've lagged the world by, what was it, 6% or something. Whereas the big six, the big seven tech stocks, there's a couple more you could add as well, have done really well. But surprisingly, net, America has lagged Japan, Europe, and emerging markets this year. And so, I think most people, aren't seeing the rotation that is quite evident. And part of that's dollar, part of that's valuation, part of that's probably the economy. But, when you start with the rest of the world, way more attractive valuations, then, that's going to work out.
Why, like, we're seeing lots of, let's talk about the gold run that's been happening. Is this just people, as we've been talking about, just people flocking out and looking for alternative investments outside of government? Why are we seeing this run in gold? I'd love to hear your perspective on that.
Yeah, so the gold, the joke about gold, it's a 5,000-year bubble or a 5,000-year bull market, depending how you want to phrase it. And these sort of the gold's relevance comes and goes. And of course, it was an official part of the financial system before 1971, and then it wasn't. And it went through a period in purgatory until about 1999, when it was dirt cheap and the smart money started to buy it. And then in 2009, the emerging market central banks started to buy it. And then since the war in Ukraine, they've accelerated those purchases. So that's been the sort of the big change. And no one wrote down on a document at the IMF or the World Bank or one of those organizations saying you need to have gold reserves. They just came to their decision by themselves. So confiscation of Russian reserves was a very controversial move. In some people's eyes, it was a very bad move. It didn't even happen during the Second World War. So, this is quite extraordinary and unprecedented historically. And reserves always seem to be sacrosanct, but they were taken. And so the result of that is, I think, a lot of central banks looked at the US treasuries in a different light. Firstly, they weren't as safe. If something goes wrong, if you do the wrong thing, then they could take them away from you. And the second thing is, obviously, they're not exactly a scarce asset. There is no shortage of US treasuries in the world. And some would say they yield enough to compensate for the monetary inflation that's out there. So there's just, and I think that's caught on, particularly in the last few months, this year and the last few months. Retail's got involved. Gold's had this stunning year. Too good, really. And about 2 years ago, we saw a top, so we're now in correction mode. It's somewhat aggressive, this correction, but we've seen far worse in the past. But it's not over, so who knows where it lands.
Yeah, exactly. What prompted you to get interested in gold? What was the thing that made you start to look into gold as an investment?
Well, I joined the bank in 1998. In 1999, randomly, I went to this lunch presentation, and maybe there wasn't a lunch, I can't remember. But a presentation, and it was given by Tocqueville Asset Management, which is still around, and they're Canadian. And the chap was very bullish on gold, and it had been going down for 20 years. And there weren't many people in the room, but I was fascinated by the story. And he gave a sort of history, how there's no one's liability, and the system will need it, and the fiat monetary system only works on increased debt and bailouts. And this was in 1999. And you've heard all this in the last 25 years for sure. But he was saying it then. And I just sort of came to the conclusion that it had a place in a portfolio. And also I'd done a technical analysis course in about 98 or 99, which my firm wasn't thrilled about, but nevertheless, I sort of did it secretly at night. And so I discovered, in those days, charts were really good because no one had them. You didn't have fancy charts on screens. They were hard to get. Some people in the previous years, people have been drawing them, every day. Seriously. So technical analysis worked really well in the era when no one had charts. So, I started to notice the 200-day moving average of the gold price turn positive at about, I think it was about 01. And it wasn't going down on the S&P. And I started to go, my God, you can think about portfolios differently. You don't have to own the thing you're told to own, which is all the stocks in the S&P and the FTSE. and you can just go further afield and wider. And over the next few years, as I say, we were very involved in commodities and emerging markets. Gold always played a role in the portfolio. There were sort of hedge funds and alternative things as well. I mean, we did all sorts, and it was a good outcome. So it was a very special time. But gold was always at the forefront, and I just became increasingly knowledgeable about the subject. I'm just drawn to it. I mean, some people are. Some people just think it's a pet rock. That's just how it is. And I think that most people who think it's a pet rock dismiss it because they don't understand the fact that alternative assets don't have a yield. If they had a yield, then they wouldn't be alternative assets. They'd be financial assets. And so those people do not understand that there's a diversification benefit that of owning things that don't have a yield because they're different. And diversification embraces different types of assets. So I think it was, if you said everything is going to go up 10% a year, but you offered me something that was 8% a year, but completely different, I said that's interesting, because it diversifies if something goes wrong.
That's really interesting. Do you think, how much of, going back to your understanding of gold, of coming across it, and how much do you think was in that presentation or lunch, whatever it was, how much do you think learning about the problem and seeing the problem with the current monetary system actually affected that? Or were you just seeing it as, okay, this is just an alternative that we can invest in, and then seeing the 200-day moving average start to turn? Was it coming from here, there's a problem here, or coming from here's an investment?
Yeah, so I would say that I probably didn't see it as something that over the next 30 years would play out beautifully. I probably just saw it as a trade that was different from a falling stock market at the time. And you couldn't buy it then. I mean, you couldn't buy gold easily. I mean, of course, you go to a bullion dealer, or you could buy a futures contract, but you couldn't. There was no ETF that came in 2003, and then London 2004. So you had to wait a while. So you bought mining shares through the Merrill Lynch Gold and General Fund, now BlackRock, and that was the standard trade. And that fund grew from 50 million quid to billions and billions by 2007. It was, as it became more and more popular. But it was a classic case of having a large exposure to something different. But it was, as I say, it wasn't the only thing we had. We were up to rivals in emerging markets, which were also different. But the common thread is that no one owned gold in the investment circles. And then when the ETF came along in 2004, by 2011, lots and lots of people did. I mean, it was pretty consensus trade by then, but it took a long time to build. The same was true with emerging markets. I mean, the joke about emerging markets, I've just been writing a note this morning on this, is that to buy them when the last fund is closed. And it might surprise you to learn that over the last 25 years, the Egyptian stock market has been the world index. When you include dividends and in constant currency. So, the currency the Egyptian pound's down 93% since this century, but the stock market's up quite a lot, and it's paid dividends. So net, you've actually done better in Egyptian stocks than you have in the world index. And I just don't think many people know that. And it would shock them. It's true for most emerging markets, in fact. They all peaked out in 2008. They made huge gains up to 2008, and they've done nothing. Typical emerging market over 17 years hasn't done much. It is still probably below its 2007 or 2011 high, depending when it peaked out. But most of them have done very little in the last decade and a half. It's true. They made so much money back then that still holds true. It's a bit like Japanese equities. I mean, they made an absolute fortune in the 1970s and 80s, but they've lagged the world since 1990. But they're still ahead if you take a 50-year view. Japan's still done better than America and Europe.
That's really interesting. Yeah. Where did you first hear, moving on from the gold we've been talking about and emerging markets and everything, where did you first hear about Bitcoin? Do you remember the first moment that you were like, oh, okay, you hearing about it and then being like, oh, this thing I need to look into?
Yeah, it was 2012, and I can tell you exactly. I was told about it by Tom Patterson, who was an economist who's sort of bit of a hippie, and he had acquired some gear on the Silk Road website. I seem to remember, allegedly, probably, and was talking about Bitcoin. And I said, "Don't be ridiculous. You can cut and paste it. If you've got Bitcoin on a screen, then you just sort of photocopy it or something." And he said, "No, it doesn't work like that." But he couldn't explain why, because no one understood it in 2012. And I just missed it, but I did follow the chart after that. And then I saw the breakout of $100 in the spring of 13. And, we're desperately trying to learn about it and find out how to buy it. And I left it all too late. And it was $1,000 before you knew it. And by the time I managed to get accounts open and stuff, I some on the way down, not much, just sort of having fun with it and sending it to different wallets. And I gave away so much. Which is terrible, £5 lumps, which are, all 200 times or 300 times. And that sort of thing. So had a lot of fun with it, and then decided to that it was going to be a big deal, and it was going to be a proper institutional asset in the future. So I started ByteTree as a part-time job. There was a full-time, my co-founder was a full-time coder to do the hard work whilst I just supported him, but I never did anything. We were just building something. And so this was an analytics platform for Bitcoin. But, where I went wrong, where I was right was that Bitcoin went up a lot. And where I was wrong was that I thought there'd be, institutional demand for an analytics platform. And there just wasn't. It was very much a retail trade. And, the central banks didn't go near it. The big institutions have barely touched it, maybe a few in America in the last year and a half since the ETF. But basically, it's just been he's been a very, very successful trade, one of the most successful in the history of the world. But on the other side of it, it just hasn't been accepted in society, in polite investment society, if you know what I mean. So the big institutions say no. For the same reason they say no to gold, by the way. I mean, it's just, where's the yield? Show me the yield.
Yeah, that seems to be. It feels like it's slightly changing now a little bit. But I want to go back. Was ByteTree? Did you say it was originally an analytics platform?
Yeah, it was called
for Bitcoin.
We changed the name a few years ago. It was a Crypto Composite was the original name, and so it was one guy building a code base. I mean, it was, but it didn't become a serious business until 3.5 years ago, when I came in full time and kicked off the research and launched Bold and those sorts of things.
Wow. Yeah, I didn't realize that. Do you think now, though, would you say now we're hitting somewhat of a tipping point where it is being more accepted on an institutional level, or do you think there's still a lot of reservations and not interest in it because of you can't get yield on it?
Yeah, I mean, it's not just yield, it's also the connotations. The Silk Road thing's never gone away. And I think I was reading the comments section of the FT or the Times or something yesterday or today or whenever I'd read it. And it's just the same comments over and over again, always use the criminals and drugs. And you just think, oh, gosh, we've come nowhere in all this time. And, there's been some interesting innovations that have come out of the space. But the thing is that the traditional finance just like to say, I love blockchain, but I don't like crypto. And the point is, the only application of blockchain is crypto. And so that's the sort of the bit that's missing in the middle. What else are you supposed to do with the blockchain? I mean, there are far more efficient databases out there. The point is that it's immutable and that sort of thing. And so it's about having digital assets. And, wouldn't that happen? I mean, you go to any sci-fi film in the last 50 years, there's sort of references to tokens and what have you. And so this is what it looks like. I mean, the reason Bitcoin has a blockchain is because you can't cut, so you can't cut and paste it. you've got this provenance. When we trade art through Sotheby's and Christie's, not something I do very often or whatever. There's a provenance, and that you have to prove that the receipts and evidence that this is yours and it's legitimate and it's real. With blockchain, we just do that automatically, and it's very clever. And that's why the system works. It's also a self-regulating system. So if one part of it goes wrong, another part of the system counterbalances it, whether it's fees or whether it's block times or these sorts of things. So you've got a very, very neat system that works like a natural ecosystem, and that's why it's never going to go away, in my opinion. But that's not a reason why the price goes to $1 million rather than back to $1. I mean, that's the investment case. But the system, I don't think will ever break. I think it's going to be resilient and will work in 50 years' time, 100 years' time, whatever. So long as people want it to work. Obviously, if everyone gets bored, then that's another matter. But it's here and it's big. And the most bullish thing about Bitcoin probably is the fact that the entire world's institutional investors don't own it. Because they will own it. I promise you, Jordan. In 10, 20, 30 years' time, they'll all own it. Yeah, it's how it works. And you got the arseholes writing these stupid comments in the FT. They're going to retire. They're going to be irrelevant. And then the new lot will come and they'll be in charge. And they'll go, well, why don't we like Bitcoin? Because we like Bitcoin. Because it'll be normal to them. So one way or another, it's coming in. Yeah, it's happening. It's a slow grind. But gold, quite a lot of institutional investors own it. Not all of them. Lots of central banks own it. But Bitcoin, no one owns it. It's the most bullish case, if you just wanted to make one point, is they're all coming.
It is. That's the beauty of it, that it has been retail can get access to it before institutions, and very much like a ground up protocol, movement, investment, whatever you want to put it into. But do you think, because I 100% agree with you on that, everyone will own it at some point, or they will be interested in it. Institutions will be very interested in it. We're getting slowly there. But do you think we're in the middle of the evolution of it at the moment? And is it just a generational thing that will tip Bitcoin into the mainstream and normalize it, rather than trying to educate those people that are currently in institutions, trying to get them to understand what it is? Or is it just the younger generation will just come through and they're internet native, they're Bitcoin native, and it just gets intertwined in society like that, and it'll be a 20 year, 30 year segment? Or do you think it will happen faster than that?
Definitely faster, because the relevance of the let's call it the grey view versus the young view, the boomer view. I hate that term, but
grey view.
But that their relevance of their views will increasingly shrink, and young people coming up through the organisations. But also, there's nothing like a price. There's nothing like a bull market to get people in. It's that you could spend $1 trillion advertising Bitcoin and achieve very little. Let the price go up 2 or 3 times, you'll achieve more. I mean, everyone loves a bull market. And if we had, this would be my dream in Bitcoin, is that the NASDAQ starts going down, Bitcoin carries on going up. Now, if that happens, everyone's a Bitcoin.
That's one of the things that I get from in the comments section, is it's just another tech stock. Look how correlated it is to the NASDAQ. And that's just someone looking at it from that investment point of view and where it currently is, rather than what you were saying around the protocol and what the blockchain actually is underneath it.
Yeah.
One thing you said beforehand, I'm just going to try and relate them to gold a little bit. This to gold a little bit is you said nobody really owned gold before, in masses anyway, before the ETF in about 2000, 2003, 2004. Do you think this is the same for Bitcoin as well? Do you think that will be a big turning point? Because we've seen IBIT in America, they've now got 100 billion or there or thereabouts within that in a record amount of time. How important do you think this point in time, because that's only been, it was January 2024 that launched. How important do you think this is for more people to own Bitcoin? Can you relate it to what you saw with gold in 2003?
Yeah. So gold was less controversial. I think you were seen as a crackpot for liking gold, and the older people in the office remember the 1979 bubble. Yeah. See, so in 2001, the smart people were buying coal mines. Yeah. They were buying emerging markets and stuff that, people have forgotten that there was no coal analyst left in the city. You know what I mean? There was all the emerging markets funds are shut down. You couldn't buy gold. I mean, yes, of course, in jewelry, of course. And you could buy it through futures, as I've said, and through bullion, but you can't do that for portfolios. You have to buy it with an ISIN code, with a vehicle. And so it was really important. But I don't think gold was deemed to be dirty. It was just seen to be a bit, as an investor, you're a bit of a crackpot because you must think it's the end of the world. Yeah. So if you like gold, then you think it's the end of the world. So there was that connotation. And I never believed that because I started to analyze it and recognize I was very early to pick up on the inverse relationship with real interest rates. And that's the difference between yields and inflation and that sort of thing. And other drivers. And I spent a lot of time trying to find what the hell's driving gold. And part of it was investment flows into the ETFs and stuff. There was the positioning in the futures market. And when Shanghai came on the scene, you could look at the price differentials across the world. So there were all sorts of things that you could do to try and evaluate, where a market is, even if it doesn't put a precise number on what it's worth. But you get the hang of it, right? And if the trend is, if the environment's in your favor and the trend's in your favor, it's going up, and you're just basically waiting to spot bubbles up. Yeah, and I think we probably just had hopefully a mini bubble, not a major bubble, 2 weeks ago in the gold market. But in Bitcoin, it came to America, and the ETFs had huge fanfare, just like gold 2004 when the first gold ETF touched America, which was after London. Yeah, at that time it was Australia first, then London, then America. This time it was Sweden first, then Switzerland, Germany, Hong Kong, Canada, Brazil, all have, and Australia all have these products, and now France, Netherlands, and then finally London, and then America, then London. So it's really quite disappointing if people wonder why London, the great financial center, is becoming irrelevant. They can't launch a bloody ETF in Bitcoin until their last, until the last place, and that's pretty pathetic. And it's the nanny state thing. It's because people have to have a view now on whether it's a suitable investment for you. Whereas in the old days, it was caveat emptor, which was let the buyer beware, and here's a product, buy if you want to. And it's still a bit strange that you can go and buy a 5x short NVIDIA product. But there are more restrictions on Bitcoin. So it's nonsensical if you ask me. But they keep making up new rules to make it difficult. Now, the ETFs, or ETNs as we call them here, same thing, are now here. They've been on the London Stock Exchange for 2 weeks, I think, 2.5 weeks. And it's been dampened because the biggest access points, things like Hargreaves Lansdown, have said, well, we're pending decision on whether we can treat this as a retail investment or not. And that's because they've got a duty of care from the regulator. And that duty of care basically means, well, if Bitcoin goes to zero, are we on the hook for it? And so there's these questions being asked. Now, of course, if you go to Hargreaves Lansdown and buy a junior oil stock and it goes to zero, no one even thinks it's that fault. But for some reason, when it comes to Bitcoin, everyone wants to go the extra mile and ask all these questions. And I think it was it was anticipation of this that is why I created the Bitcoin and gold combo. And can we come on to that, John?
Yeah, please. Yeah.
And it was just sort of, I remember asking the question before I left HSBC, how the hell would you put 2% Bitcoin into a portfolio? The ETF was just launching in Sweden, or just come. It was a small note, it was $1 million. And it grew quite quickly once the platforms allowed it. And I think it got through because no one really knew what it was. And I think as soon as they found out what it actually was, they were all upset they never put it on their platform in the first place. So because Hargreaves allowed you to trade those Bitcoin ETFs until from 2015, 16 to 2021, to January 2021. And so people sort of changed their mind on those things, to your point about life after 2020, after the pandemic. But I sort of realized that the way to put 2% Bitcoin into an institutional portfolio, you'd have to have a vehicle for an ETF, ETP. And then I thought there'll still be a problem because it's Bitcoin. And so I said, well, if you put Bitcoin and gold together, then maybe that would soften the blow and you could risk weight it. That's what we do. And more importantly, they're a natural combination. So just putting them together for the sake of it wouldn't have been a good reason. But it was the fact is that these two assets have a different driver. And so when things are going wrong, normally, if gold's been going up recently because it's been going up, because it's been going up. But you take a 10-year view, 1,000-year view, gold tends to do well when things are going wrong. And Bitcoin, we only have 17 years of history, 16, 17. And it tends to do well when things are going right, in very simple terms. The other thing they have in common is limited supply. The other thing in common is the fact that they're naturally counter-cyclical. They're alternative, neutral global assets. So you can walk around. You can use your Bitcoin. It has value in Japan, and it does in South Africa, as it does in Brazil, as it does in Canada. And the same is true as gold. They're both globally accepted, neutral, alternative assets outside the system. After Ukraine, we were talking about earlier, what happened? They went to gold. And they could go to Bitcoin. They haven't done. I mean, well, El Salvador has, but most of them haven't. And but they could one day. I mean, it's not implausible. But they would say, okay, that's a useful alternative, particularly if the non-correlation stays there. I remember what I said earlier about, you find something that's different. That's really interesting, because if you put two different assets together, you get a better outcome. And the way you lock that in is by rebalancing. So what does Bolt do? Is it takes the risk-weighted approach. At the moment, that's roughly speaking 70% 70% gold, 30% Bitcoin, and then at each month we rebalance back to those risk weights. And so if gold does very well and Bitcoin does very badly, we're selling gold, buying Bitcoin at the end of the month, or vice versa if it's the other way around. And you're just locking in. You're locking in the difference in their behavior, and that is a very useful thing to do over time. So the thesis behind Bold is that you've got low correlation, you've got two liquid or highly liquid alternative assets. Gold's as liquid as the S&P 500, and Bitcoin is the second most liquid alternative asset in the world, more liquid than silver and those things. So if you want to make something that's non-financial, this is a great way to do it. And it just, and I've sort of took the view that it would work for portfolio managers, because you're all managing other people's money. You have a responsibility. If in the 1 in a zillion chance that Bitcoin did go to zero, well, you're not going to zero. But more importantly, you're always going to have a calm ride, because if you own the two assets independently, then they're always going to have good and bad years. There's always going to be a difficult conversation. But if you put them together, it's just a lovely outcome. It's why the city sells equity and bond portfolios historically, because they're just nothing to see here. They take it in turns to make money. Now, bonds have had a terrible 5-year period, but notwithstanding that, longer term, the equity and bond combo is well trodden path. And I'm saying, okay, we could do that on alternative assets too, Bitcoin and gold.
Yeah, it's really interesting, and I really like what you built with Bold, because there's so many similarities between people that like gold and people that like Bitcoin. Like, they understand why they're making that investment. Is there a reason? I've got a few questions, but is there a reason why you picked 70-30.
I didn't pick it. I risk weighted it. So I was giving you the short pitch. I can do the longer version. And that is risk weighting. What is risk weighting? Right. Everyone splash your face with water and we're going to see that. It's pretty boring. So we look at the volatility, how much a thing moves up and down each day. And Bitcoin's volatility, let's call it 40%, which it was a few months, just to keep the numbers round. And let's pretend gold's 20%. It's actually about 80. It's just nice round numbers. And so the math is very simple, that you do a reciprocal and add them together. It's on our website. You can see the methodology on boldetf.com. Go there, see the presentation. It's very transparent. But the bottom line is, if you've got a very volatile, gold's not very volatile. Bitcoin is not very volatile these days. It keeps coming down. But let's say it's 40%, which is in line with a typical oil stock. And gold is 20. You're going to have the opposite amount of exposure. So you're going to put a third into gold and 2/3. I can't get this right, can I? A third into Bitcoin and 2/3 into gold. Yeah. So basically, as Bitcoin volatility comes down, its weight goes up in the index. If Bitcoin and gold volatility were ever the same, it'd be 50-50. Whether they were both 10 or both 50, it wouldn't make any difference. It would be a 50-50 partnership. And what's happened is that, in the end of 2017, when Bitcoin volatility was through the roof, the index, where it wasn't a product then, but the index was 5% in Bitcoin, 95 gold. But as Bitcoin's calmed down and grown up, particularly since the US ETFs have been launched, it keeps on coming down. We're now into the 30s. And so it's heading for 2/3, 1/3 in favor of gold. I can't see gold being bigger in my lifetime, but it's plausible that it happens one day. Bitcoin becomes less volatile than gold, then it would happen.
Wow. So it will just, so that number, that 70-30 will just keep, or the Bitcoin side of things will keep expanding, the weighted of that. And then as the volatility.
Only if its volatility comes down. So if Bitcoin becomes irrelevant, its volatility will probably pick up again. So there's a bit of safety here. So if you think, firstly, if Bitcoin's in a bubble, its volatility will go up. So if we have a crazy moment like 2021, you have high vol era, and the weight will go down. So you've got less risk in your portfolio. It's all about risk. You'll have less risk in the portfolio. And the other thing is, if Bitcoin becomes irrelevant, and people just sort of stop playing with it, then its volatility will go back to, shitcoin levels, where you sort of see whatever Dogecoin is or whatever, in the hundreds. And then the weight will be very small. So basically, the product is designed, what would happen over the next 100 years? What are the scenarios? Well, gold becomes irrelevant, then that's volatility goes up. You end up with a largely Bitcoin fund. Bitcoin becomes irrelevant, you end up with a largely gold fund. They pair off 50-50, fine, they're both relevant. And so you've got that sort of long-term aspect to it, to say, without me making a decision about which one I prefer each day, it's a very robust mechanism to try and understand these two assets. And I think it's behaving as expected. Bitcoin's becoming more relevant, so the weight goes up. I'll take that. That was what's supposed to happen. But it's a defense mechanism should one of them go horribly wrong, in part. But also, as I said, the rebalancing transactions, because they work against each other, you pick up about 5-7% each year from that, which is quite a lot, if you compound that. So, that's certainly what we've experienced over the last 3 years, and the back test will also suggest that that's something that would have worked even better in the past. But of course, it's, the obvious thing is, pre-2017, if you diversified your Bitcoin, then you're disappointed. Pre-17, Bitcoin goes from 6 cents to $20,000. I mean, if you diversified, that bad luck. But I think since 2017, it's behaved much more normally, and particularly since 2021, it's behaved much more normally. And so, if you think Bitcoin finally can go up 10 times, so can gold. There's more of a level playing field. Obviously, Bitcoin's most likely to outperform because it's smaller. It's 2 trillion rather than 25 trillion. So there you have it. It's got more potential to go up, I would think, but it doesn't have to outperform gold. I mean, anything can happen. The future's unknown.
Exactly. That's the beauty of it. The future is unknown, and I mean, you both bases are covered there in a direction that we are going where fiat, but it looks like fiat currencies are becoming a lot more irrelevant. And just on the looking at the asset sizes, the market caps, do you think there will be a situation or a scenario, or how long do you think it will take? That this is, I've not got this question worded right, but gold is sitting at roughly, let's say, 25 trillion market cap. Bitcoin's at 2. And do you think that Bitcoin will catch that? And do you think there is risk, or it's not risk in a bold situation because it'll just rebalance, but do you think that there is a situation where Bitcoin will overtake gold?
Well, of course there is. And I mean, I don't think it's my central forecast. I think it's unlikely. If the central banks come in and if all the institutional investors come in, then and buy Bitcoin like they have done in the same way they bought gold, then it goes to 25 trillion. I mean, by definition. If it became even more accepted than gold, because let's say most institutional investors don't own gold, central banks do, but the institutional investors don't own much. But if everyone sort of went all in, then the number's much higher than that. I mean, the multiplier of putting money into an investment and the value of that investment rising is probably 5 times for a large liquid asset. So, I think that, and that's why the S&P is so high, because it's 100. Well, the global equities are 140 trillion or something, and all this money comes in every day, and most of it goes into the S&P 500. So it's that you see it work there. Yeah, I mean, if everyone wanted to own Bitcoin in the same way they want to own gold, yes, the market caps would match. I don't see why they wouldn't. But I don't think it's a likely scenario.
Do you think, just in terms of Bitcoin being more superior in the terms of medium of exchange, do you think we will see it get more widely adopted because it's got so many more characteristics of money than, because there's that argument of, is Bitcoin just an asset or is it going to be global money? Where do you sit in that camp?
I think I'm in the asset camp, but I expect innovation around it. So, but I think that it's got different levers and different, different interests, different people. I mean, some people want it to be physical, as in a wallet, and be able to make most of the use cases of those benefits. I mean, but if you're an investor, you don't care. You just want to own it in an ETF, ETN, and you care about the price. But the two feed off each other, you see. So you've got to put capital in to support the price. So if there were no ETFs, then the price of Bitcoin is going to be, I don't know, sub 5,000 or something. And if there's no big institutional money coming in, then it really isn't worth very much. So you need to have that, and you need to have the innovation and the vibrant network, and they're all to play off each other. Look at the gold market. You've got bullion people. You've got jewelry, which is huge. It's half of gold's annual supply. Price is too high for jewelry, probably. There's a little bit of industrial use, dentistry, and high-tech circuitry. And then there's recycling. But the jewelry thing is really important because whenever the price of gold goes down, the jewelers buy it. The central banks buy it. I bet you China stopped buying gold. And they're going to report a disappointing quarter because the price went up too much. So they'll just stand back, let the market crash, and then go, okay, we're back. So that's the value buy. So, gold's got two rock solid, big, deep pockets value buyers. The global jewelry market. What, are you not going to get a wedding ring for your bride? You know what I mean? You have to buy that ring. You have no choice. You'd rather buy that ring than pay the electricity bill. So that money is going to be spent on gold. And then you've got the central banks who are a long-term source of demand, certainly in uncertain times. And if Bitcoin can have those big, deep value buyers, then the volatility comes right down to gold levels. And then it becomes, and that feeds again. So the more liquid it becomes, the less volatile it becomes, the more the institutions will look at it and say, well, it's not that risky, is it? And they'll start to take more interest. So it's hard work, but Bitcoin's done a huge amount of work over the last decade and a half to get to where it is in terms of its credibility and infrastructure. The number of exchanges, the number of wallets, the number of things that plug into it, trading pairs and perpetual futures and DeFi. I mean, there's just so much. It's crazy. And the more you build stuff around it, the more secure it is. And so they feed off each other again. What if you take Litecoin or something? What is there for Litecoin? I mean, nothing. So Litecoin is not worth anything.
Yeah. Even, I don't know if you saw the founder of Litecoin coming out.
Really, isn't it?
He came out, I want to say about 2 months ago, and said, yeah, you probably should have just bought Bitcoin and just sat on it rather than making Litecoin.
But I'm sure he must have done very well about it in 2013. I think he'd wanted it. Maybe it was 12. But I mean, the early days, people thought, neck and neck. It was 2 horse race, and it was faster or something. I think the shot block time was shorter or something like that. I can't remember. But it's funny that anyone can copy Bitcoin and make their own identical network. But good luck with getting everyone to jump on board.
That's a great way to round off the podcast. Charlie, thank you so much for jumping on. And I really like these discussions where we're talking about gold, Bitcoin, emerging markets, and like talking it holistically as a whole, like how we invest. And you're one of the great speakers on that. So thank you very much. And you'll be at our next conference in a couple of weeks. It'll be great to it'll be great to have you there. And it's like a Dragon's Den vibe, the venue that we've got. I'm looking forward to everyone seeing it.
Good stuff.
Brilliant. Charlie, I will put all your if anyone's listening and wants to reach out to Charlie or ByteTree, I will put all your details below for people to do so. And I'd encourage them just to go and check out Bold as well. I really like what you've built there. Perfect. Thank you very much for joining me.